Right, so let's talk about your financial portfolio and let's talk about your strategies as far as fixed income is concerned. And also, with so much of uncertainty going on in the global markets due to geopolitical tension, we also have a relief from our end where we saw IMD predicting a normal monsoon. But then, how much of it is actually a relief for us, and how will the geopolitical tension impact our markets, and not only our markets, it impact on rate cuts and inflation? Let's talk about all these aspects and get you a complete strategy for your financial portfolio. I have with me Mahendra Kumar Jajoo, CIO, Fixed Income, Mirae Asset Investment Managers. Good evening and welcome to the Money Show, Jajoo sir. And I think we missed you last week having on the show. Guess you were traveling around the MPC meets and the other inflation announcements. But having said that, a lot has changed in a few days, especially talking about the latest development on the geopolitical front. We've also seen a great run up in gold and crude rate cuts. We've spoken so many times, and I still remember last year around this time, we all were anticipating rate cuts in the second half of the calendar year. And, we are somewhere around the same timeline doing the same kind of discussions. How would you analyze the situation of uncertainty so far for equity as well as debt markets?
So as you said, a lot of things have happened, and especially the developments have been very fast-paced in the last 15 days. But like in the last year also, we were saying that markets were at that point too optimistic, and now things are evolving in a way that, in my personal opinion, the space for the rate cuts has opened up for Fed as well as for the Reserve Bank. However, there is still going to be some watch before they can cut the rates. Insofar as the Fed is concerned, the market is worried about the inflation having come higher than what the market was expecting, and therefore there is some concern in the market that the Fed rate cuts may be delayed. I would like to believe that if the inflation remains at around the current levels, then it will be possible for the Fed to cut rates sometimes in the months of July, August. So next quarter is somewhere we can expect a rate cut. The reason being that while the inflation is not coming down closer to the Fed's target, still the real rates in US are very high. The inflation was at 9% when the Fed was at 5.5%. Inflation is now at about 3.5%, 4%. So obviously the Fed cannot go back to 0% rates, but the Fed can easily come to close to 4.5, 4.75. So I believe Fed can cut rates by 50 to 75 basis points in the next 6 months. That doesn't mean that the markets will have to rally, because to a large extent the yield curve is already inverted. So a bit of a discounting of the possible Fed rate cuts has already happened. Insofar as India is concerned, our inflation has now come below 5%. RBI is projecting an inflation of 4.5% in 2 quarters' time. So again, with repo rate at 6.5%, with the fiscal deficit being in a very strong situation, with the projections for the next year's fiscal deficit at 4.5%, with monsoon forecast being normal, and with the global rates expected to come down, I think there's space for the Reserve Bank to cut rates. But we are now dealing with a new development on the geopolitical front. Iran and Israel conflict news is coming. That will have impact on the energy prices. That will have impact again on the global supply chain. So therefore, I think the central banks will be a little watchful, and RBI may cut the rate 1 or 2 times after the Fed starts the rate cut process.
But, let's talk about US specifically. Do you see an inflation boom coming over there? Because the kind of data that we are that's coming up, which is quite robust. Do you really think the stand will not change and you're still looking at rate cuts, or you think this situation is further to be analyzed depending on the data if it continues to be robust? Or according to you, what's the kind of data which also, is pointing out towards a rate cut in the time horizon that you mentioned?
So the point is that when the central banks are at a pause, the market has a far more elbow room to be volatile. So every data point that comes in leads to fresh expectations and resetting of the earlier expectations, and therefore the markets can turn volatile. So just 3 months back, if you look at this environment, markets was waiting on a 150 basis points rate cut. Has the things, has the environment changed so much that now people expecting no rate cut? I think that kind of volatility in the market is normal, especially when the guidance from the central banks is somewhat fuzzy. And that's what has happened. So market has swung from expectations of a deep rate cut to no rate cut to delayed rate cuts now. This is not the first time this is happening. We are in the first fortnight of April. Please go back to the March of 2023 when the uh, that California bank collapse had happened. And at that point, market had factored in a near certain possibility of a rate cut by Fed in the months of April, May of 2023. And from that situation, by the time the October 2023 came, market was braced for higher for longer rates. And then by November 2023, Fed was already talking of possible rate cuts. So I think the environment is so volatile and fragile that month to month, data to data, the market expectation changes very frequently. But let us not forget that the core fundamentals have not changed so much. So the fact that inflation has fallen from a record high of the last 40 years to a more manageable level, there is no immediate threat to a runaway inflation. There is a possibility that the inflation remains sticky at around current levels. There is a possibility that inflation goes up somewhat because of the base effect, because of the renewed momentum in the energy prices, because of the renewed momentum in the other commodity prices, because of the possible disruption in the traffic movement in international trades because of the geopolitical conflicts. But it does not change the base situation that in the last leg of the rate hike cycle, Fed was ultra aggressive. They hiked the rates by 100 basis points when the inflation was very high. From those levels, the inflation has come down significantly. So even though the market is very volatile and the mood swing is very, very dramatic, I think the core uh, approach to a gradual easing of the rates from their recent high, I think it is still valid. I think that Fed will cut rates in the months of July, August. The rate cut cycle will be shallow. Fed will cut to reverse the ultra aggressive rate hikes of the last leg, last 100 basis points, and then Fed will watch how the things evolve. Insofar as India is concerned, as I already explained, macro environment is absolutely fantastic. And then if you have a normal monsoon, of which we will have a fair idea by June, July, RBI will be in a position to indicate if the rate cuts can start at that point. But again, in India also the rate cut will be very shallow, maybe one or two, 25 basis points rate cut.
Talking about the triggers that are there for us, okay, IMD predicted a normal monsoon and El Nino weakening. But what's the status as far as La Nino is concerned? Because it has a completely opposite nature of an El Nino. Also, so far we are in April. What if the predictions or we see some kind of a difference in the estimated timeline of monsoon coming up? Inflation, do you see going up? So far we've come under the comfort band of RBI as well, but then if fuel prices go up, we'll again see food and fuel inflation becoming a problem for us.
So let us first put the record straight. If the monsoon is delayed or if the monsoon is deficit, if the oil prices go up to $100, obviously the assessment will have to be revalidated. And if the new assessment says that no rate cut, then no rate cut will happen. So precisely because the environment is so fragile, as I mentioned, and things can change overnight because of the geopolitical events or because of the climatic events. Uh, the central banks are very watchful, which is why if you look at the last guidance of the Reserve Bank, it says that look, there is not even a discussion of a rate cut on the table. So that I think is showing the cautiousness and recognition of these uncertainties in the market. Now, what happens if these uncertainties do not come into play? My personal view is that monsoon will be all right. There is another very important development that we have to take note of very carefully, that in the last 2 years, the inflation has been controlled to a very reasonable level in India because of the active supply management measures taken by the government of India. So you have seen the ban on wheat export, we have seen ban on sugar export, we have seen multiple measures taken by the government to ensure adequate supply of pulses or of other agricultural commodities into the market. So therefore, I think apart from the impact that the monetary policy has had on the inflation, there has been a very significant contribution by the preemptive and effective measures taken by the government of India on the supply side. And we have seen the Reserve Bank go on a pause in February 2023 itself, while the Fed was still hiking rate, because the Reserve Bank also spoke about the supply side measures being taken by the government of India in its policy document. So it's a combination of the fiscal, administrative, and monetary measures that has ensured a steady state inflation in India. And there is no reason to believe that this will just disappear overnight. And therefore, I think it's a fair thing to assume that inflation will remain well behaved in our country, unless obviously there's a major disruption because of the geopolitical environment, in which case obviously the assessment will have to be rebased.
So it's time to go in for short-term strategies in debt in case you want to park in, or you think it's the time to consider long-term, if at all, debt mutual funds or any other fixed income as an investment instrument you want to consider?
See, the way the equations are right now, we are looking at no possibility of a rate hike by all practical means. So the debate is between no cut and a possible rate cut. To some extent, the markets have already discounted, rate cuts sometimes in August, September, or people who are very conservative in November, December. Those expectations can change, but the likely change in the expectation is from a rate cut forecast to a no rate cut scenario. Therefore, to the extent that interest rates are already at close to their current cycle high, to the extent that the liquidity is still, just about balancing, it just last 15 days that the liquidity in the system has improved. But before that, because of the tight liquidity, the interest rates have been higher even at the shorter end, and the yield curve was very flat. So to that extent, I think it still makes sense to remain invested at the far end of the curve. But now there are, for the last 15 days, developments that are putting a doubt in mind on the possibility of a rate cut, putting a doubt in mind on the timing of the rate cut. Therefore, obviously, immediately there is a bit of a adverse reaction in the market. Now, to some who believe in the macro fundamentals and in the core inflation remaining well behaved both domestically and globally, it's an opportunity to add to the portfolio. For people who do not have that kind of confidence in the inflation projections, for them maybe there is some reason to become a little skeptical. I am in the camp who looks at the current disruption in the market as an opportunity to add further to the portfolio, because the underlying fundamentals are strong. We have also seen that increasingly there is divergence in the monetary policy globally. So you have Fed, which is very circumspect still, but you also have ECB, which has given a clear indication of a rate cut in the June policy. India is somewhere in the middle. So even if the global interest rates go up because of the domestic factors which are prevalent in US, it doesn't mean that Indian rates have to also go up. So I think at this point, one should be more constructive and optimistic than being skeptical and miss out on the opportunity.
Sure. All right, so make the most of the timings and the opportunity. Thank you so much, Charusa, for being on the show and helping our viewers with understanding not only the current market situation and also helping them with strategies for their fixed income. Thank you.
Thank you.